Investing in mutual funds can be an excellent way for you to enter the world of investing. In this video, we will cover the basics of mutual fund investment, from understanding what mutual funds are to making your first investment. Think of a mutual fund as a big pot of money. Lots of different people put their money into this pot. Then, a professional known as a fund manager takes care of this pot. The fund manager's job is to use this money to buy a mix of investments. These could be stocks, shares in companies, bonds, lands to companies or governments, or other assets. The goal of a mutual fund is to make more money for the people who put their money in the pot. The fund manager does this by choosing investments that they think will increase in value over time. Here's the cool part. When you put your money into a mutual fund, you're buying a small piece of everything in the pot. So instead of just owning one company's stock or one type of bond, you get a little slice of a whole bunch of different investments. This is great because it spreads out your risk. If one investment doesn't do well, you have others that might be doing better. In return for managing the fund, the company running the mutual fund charges some fees, which are usually a percentage of the money you have invested in the fund. Let's take a look at the types of mutual funds. First is index funds. An index fund is a collection of stocks. Each stock in the index represents a piece of the overall picture. For example, the SEP 500 index includes 500 large companies from the U.S. stock market. The index tracks the performance of these stocks. If, on average, the stocks in the index go up in value, the index goes up. If they go down, the index goes down. As different indexes represent different parts of the market, for example, the Dow Jones Industrial Index includes 30 large, publicly owned companies based in the U.S., while the NASDAQ Index Composite includes many technology companies. An index plays a vital role as it acts like a thermometer for the stock market. Just as a thermometer measures temperature, an index measures the financial temperature of the market or part of it. The second type of mutual fund is an equity fund. Imagine you have a big basket and you fill it with little pieces, shares of different companies. Equity funds are like that basket. Equity mutual funds allow the fund manager to buy shares of many different stocks across various industries and indexes. So instead of buying the whole stock index as you can with the index mutual fund, the equity lets the fund manager pick specific stocks from different indexes to maximize your profit. Thus, you pay more fees for the manager's work. The third type of mutual fund is fixed income funds. Now, picture a safer, steadier path. These funds invest in things like bonds. When you buy a bond, you're lending money to the issuer, government, or company, and in return, they promise to pay you back later with interest. Fixed income funds aim to give you regular, predictable income, usually with less risk than equity funds. The fourth type of mutual fund is balanced funds. Think of balanced funds as a mix of the excitement of a roller coaster, which is equity funds, and the steadiness of a walk in the park, which is fixed income funds. These funds invest in both stocks and bonds. The idea is to get a balance, some potential for growth from the stocks, but also some safety and regular income from the bonds. The fifth type of mutual funds is the money market fund. This is the most cautious kind of fund. Imagine a very short, very safe walk. Money market funds invest in very short-term, high-quality debt. This could be like lending money for a few days or weeks to a bank or government. The risk of losing money is very low, but these funds also offer lower returns. They're more about keeping your money safe than growing it a lot. The sixth type of mutual funds is the sector funds. Think of focusing your camera on one specific thing. Sector funds do this, but with stocks. They invest in a particular part of the economy, like technology, healthcare, or energy. If you believe a certain sector will do well, you might choose a fund focused on that area. But remember, focusing on just one thing can be riskier. If that sector doesn't do well, your investment might suffer. Lastly is the international funds. Imagine taking your investment dollars on a world tour. International funds invest in companies outside your home country. This could mean companies anywhere in the world, including emerging markets or countries with growing economies. This can be exciting and offer new growth opportunities, but it also comes with additional risks like changes in currency values and different economic conditions in other countries. Choosing the right mutual fund can feel a bit like detective work, but it's simpler than it sounds. Here's how you can do it in a straightforward way in 3 steps. First, researching funds. Think of this as getting to know someone before you become friends. Start by looking at how the fund has performed in the past. But remember, just like a person's past doesn't predict their future, the same goes for funds. Then, check out who's managing the fund. These are the people making the investment decisions. Also, peek into what the fund is investing in, like stocks, bonds, etc., and how much it costs to invest in the fund. This is called the expense ratio. Lower costs usually mean more of your money is going into the investment, not fees. Second, read the prospectus. Every mutual fund has a booklet called a prospectus. It's like a guidebook that tells you what the fund aims to do, how it plans to do it, what fees are involved, and the risks it might face. Reading this helps you understand the fund better. Third, diversification. This is like not eating the same food every day to stay healthy. Don't put all your money in one type of mutual fund. Spread it out. Maybe some in equity funds, for growth, some in bond funds, for steadiness, and others in different types. This way, if one type doesn't do well, the others might make up for it. Now, it is the time of making your first investment. To start buying mutual funds, you must open an account with a brokerage such as Fidelity Investments, Charles Schwab, Vanguard, Merrill Edge, and many more. Think of it as a special shop where you can buy different types of mutual funds. Look for one with low fees and good customer service. Setting up an account is usually pretty straightforward. Once you've picked a mutual fund, decide how much you want to invest. You can buy shares either straight from the company that manages the fund or through your brokerage account. Your brokerage will guide you through this with simple steps on their website or app. Monitoring your investment. After you invest, keep an eye on how your mutual fund is doing. It's like checking on a growing plant. Does it need more water? Investment? Is it getting enough sun? Performing well? Regularly review your investment and see if it still fits with your goals. If things change in the market or your life, you might need to make some adjustments. Remember, investing in mutual funds is not a quick way to make money, and there is always the risk of losing capital. It's important to align your investment choices with your financial goals, risk tolerance, and investment timeline. Consulting with a financial advisor can also help in making informed investment decisions. If you like this video, hit the like button and subscribe for more finance videos. Thank you for watching.